Lately, I've been hearing about this idea of a V-shaped recovery for our economy. Following the recent sell-off and the pandemic we're all dealing with, there's this idea of what's going to happen next. How will the stock market rebound? How will our economy rebound? And one of the things I seem to be hearing more than ever is this idea of a V-shaped recovery or V-shaped models of recovery. Before I jump into this, let me just say, please subscribe if you find this information valuable and also hit that like button. And if you don't, no problem at all. So let's jump into this quickly. A V-shaped recovery is exactly as it sounds. It's the idea that as the market goes down very quickly, it should go up just as quickly, forming a V-shape. Pretty simple. The part that's not so simple is that not everything moves the same speed or in the same direction. So if you're a new investor and you're listening to all these different pundits talk about what's likely to happen, you have to remember it's based on statistics and probability. There may in fact be a high probability of a certain chart pattern forming, in this case, a V-shaped recovery. But it's important for you as an investor to stay and stick with your goals, because that's what's going to guide you forward here as you're learning these different things. Now, knowing the terms like what a V-shaped recovery is very important. And if you think that there's a good chance that's happening, that's a great reason to stay invested in the market. Continue to add over time as things have hit lows. But very importantly, it's good to know that it doesn't mean it's going to happen. And please keep in mind that even if the market as a whole does recover vertically very quickly, it doesn't mean that all stocks or all positions will recover the same way. So that's it for today. Thanks.